Thanks very much. My name's Emma Hurd, and I'm the CEO of the investor group on climate change, representing Australian and New Zealand investors. It feels like there's a little bit of an Australian presence here today, I have to say. I think we're making inroads into the North American investor market. It's my great pleasure to moderate a panel of fantastic speakers today, really rich and deep expertise, looking at the question of how asset owners are managing climate change risks and opportunities from a number of different perspectives, countries, jurisdictions, and operating markets as well. So I think that, as you can probably tell from the program and looking at the speakers, the panel that we have today is a world-class panel of leaders of 6 of the world's largest and leading funds, collectively managing around 3.5 trillion in assets under management from Denmark, from Norway, from Japan, from Canada, and from both coasts of the United States. How we're looking to run the session today is that I'll ask each of the panel members to provide an overview of the activities that they're undertaking in their fund and some of the recent exciting announcements or actions or initiatives that they're supporting and undertaking. And then I think we'll take a little bit of a step back and look at how this applies across some of the trends across the investment industry as a whole and the industry sector as a whole. I think we have a lot of speakers to get through, so I won't take any more time. But what I will do is just introduce the panel, and then we can begin getting into the content of today's session. So starting from my left, we have Peter Damgaard Jensen, who's the CEO of the 40 billion Danish pension fund PKA, and also chair of the European Institutional Investors Group on Climate Change. Then we have Hiro Mizuno, who's Executive Managing Director and CIO of Japan's 1.5 trillion government pension investment fund, or GPIF, which is the world's largest investment pension fund, and who's also a board member of the Principles for Responsible Investment. Then next down the line we have Michael Sabia, who's President and CEO of the 250 billion Caisse Depot from Canada, or CDPQ, Canada's second largest and North America's third largest fund. We then have Yngve Slyngstad, who's CEO of Norges Bank Investment Management, which manages the 1 trillion Norwegian sovereign wealth fund, the world's largest. So I feel like there's a lot of money sitting at this table at the moment. Next, obviously down the line, we have Scott Stringer, who's New York City Comptroller, who serves as fiduciary and advisor to the city's 5 public pension funds, which manage around 185 billion in assets. And then we have Betty Yee, who's California State Controller, providing fiscal oversight for the state of California, the world's 6th largest economy, and serving on the boards of CalPERS and CalSTRS, the United States' 2 largest pension funds. So, Betty, having worked my way down the line, I'm going to stay down that end and ask if I could just ask you to provide an overview of your fund's climate-related strategies and plans to kickstart the conversation.
Sure, absolutely. Thank you, Emma. As a board member of CalPERS and CalSTRS, I think I'll just remind everyone that we have a combined portfolio of more than $535 billion across all asset classes and have more than 2.8 million members. And this is really our focus. Is to serve our 2.8 million members with the work that we do. CalPERS and CalSTRS has joined more than 256 institutional investors with more than $28 trillion in assets under management in Climate Action 100 Plus that you've been hearing about all day today. Climate Action 100 Plus is an initiative to engage the world's largest carbon-emitting companies with the goal of improving their governance, increasing disclosure of climate risks and opportunities, and reducing emissions to be consistent with the 2 degrees Celsius target in the Paris Agreement. And both funds have integrated climate and other environmental, social, and governance risks into the investment processes across asset classes. But with respect to what both funds have done in terms of significant investments, each fund has really done its share. CalPERS has made significant investments in large wind and solar projects in California. We've also invested in energy-efficient commercial buildings that are valuable assets in a sustainable portfolio. CalPERS purchased an ownership stake in a company called Desert Sunlight that operates 2 solar photovoltaic power facilities near Palm Springs. And the plants have a combined capacity of 550 megawatts, all of which is sold to California utility companies. CalPERS also has a successful history of engagement with portfolio companies and ESG topics, including climate change and natural resource availability. And in 2015, a group of investors participating in the IIGCC's corporate group engagement with Royal Dutch Shell decided that more needed to be done to ensure the company's board appropriately addressed climate risk. And those investors form what aiming for a coalition to shape shareholder resolutions for British Petroleum and Shell. And both BP and Shell agreed to support a proposal on climate risk reporting, and this was in 2015. BP additionally dedicated $8 billion to its alternative energy business and 20% of its research and development budget to low-carbon strategies. As a result of the CalPERS engagement, Shell also started a $21 billion biofuel joint venture with Brazil's Cosan. In 2016, CalPERS co-filed shareholder proposals addressing climate risk reporting at Rio Tinto, Anglo American, and Glencore, and these proposals received more than 96% support. And last year, climate risk reporting proposals passed at ExxonMobil and Occidental Petroleum, a petroleum and natural gas exploration and production company operating in the United States, Latin America, and the Middle East, were successful. So the ExxonMobil resolution was co-filed by CalPERS, CalSTRS, and other investors, including New York State Common Retirement Fund and the Church of England. And the resolution required ExxonMobil to report on environmental risk and opportunities associated with climate change. And as a result, ExxonMobil is conducting an assessment of the company's portfolio under the 2-degree scenario. And the Occidental Petroleum proposal received more than 50% support and represented the first time that a climate risk reporting proposal received the majority of votes at a U.S. oil company's shareholder meeting. Investor engagement was an essential part of these successful campaigns. And after increased pressure from investors for Exxon to have a climate competent board, the company last year added an atmospheric scientist to the board of directors. And this is really all out of the engagement process. Equally proud of CalSTRS with also engaging companies in the oil, gas, and utility sectors and tracking risks associated with pipeline integrity. The focus is on companies' leak detection and repair protocol, as well as the approval processes and financing of projects. In fiscal year 2016-17, CalSTRS engaged 4 oil and gas companies and 15 utility companies regarding efforts to manage methane leaks, which led to the filing of 4 shareholder proposals asking for improvements in leak detection and disclosure about these repairs. CalSTRS also has committed $2.5 billion to a low-carbon index strategy and has made significant investments in green bonds. So all told, I'm just proud of the investment and engagement by CalPERS and CalSTRS to address climate change and doing our part in terms of the transition to a low-carbon economy.
Thanks very much, Betty. And I wonder if I could turn next to Comptroller Stringer, just to tell us a little bit about some of the actions that the New York City pension funds are taking on climate change.
Well, I just want to say I'm very happy to be here, and as City Controller in New York City, I ask everybody after this conference to spend money, go to restaurants. We need all the help we can get, but that's just my plug. But I'm actually very glad to be here because for our boards and for the work that we do, the stakes are very high. More carbon dioxide is in the atmosphere today than at any point in the last 400,000 years. And experts put the potential economic losses to America as a result of climate change to be hundreds of billions of dollars. And Martin Luther King said that there should be a fierce urgency of now, and I think that as it relates to our environment, the moment has arrived. So for us, this is not just an environmental threat, it's also an economic one, because the money that we hold are the firefighters, teachers, city workers who rely on us for a secure retirement. And we worry about climate change as it relates to that. So as the fiduciary of our pension fund, along with Scott Evans, our Chief Investment Officer, who's here with us today, we are enthusiastic participants in the recently launched Climate Action 100 that Controller Yi highlighted, and I want to thank her for all of her work nationally on these issues. We also continue to be one of the leaders of the Boardroom Accountability Project, where we filed proxy access proposals at hundreds of companies, including more than 36 fossil fuel producers and high-emitting companies. We're increasing pressure on companies to establish goals for reducing their greenhouse gas emissions. The pension funds already have $3.6 billion invested in clean and renewable energy and energy-efficient assets, and we hope to be doing even more. This already represents about 24% of our infrastructure portfolio and 40% of our private real estate assets. But we're also taking another step. New York City is now the first to set a formal goal of divesting from fossil fuels over the next 5 years. I recognize it's a complex process and won't be easy. I also recognize for many people in this room, this is certainly controversial. But crunching the numbers and making a plan consistent with our fiduciary duty is something we believe we must do, because moving toward divestment in some respects is the future, because the stakes are so enormous. Divestment from fossil fuel companies complement engagement and the strategies that are outlined here. So I hope that we can all partner together and work together. Every tool must be utilized so we can really have an impact on the climate of the world, and that's why it's so important to be here today with the United Nations. Thank you.
Thank you very much. Thank you. Yngve, I wonder if I could turn to you now in terms of the work that Norges has been doing in terms of corporate engagement on climate change issues and some of the expectations that you set for the companies that you invested in. Could you tell us a little bit more about why your fund has taken these steps and some of the actions that you're undertaking as well?
Is this working? Okay, thank you, Emma. So the Norwegian fund is a $1 trillion sovereign wealth fund. We have one simple mission, and that is to safeguard the country's financial wealth for future generations. We are invested in more than 9,000 companies around the world, the total equity investment approaching 700 billion, which gives us an average ownership of the world equity market of 1.4%. Now, as such, we consider ourselves both a long-term owner and a universal owner, and therefore the development of the economic sustainable growth for the long term is in our core interest. We have put climate change as one of our focus areas for our ownership work all the way back to 2005. And I can tell you that a decade ago it was more difficult than today to get the attention from companies and other investors about this issue and about the risk that we face also at our financial return on our investments. So how we in practice developed our work on dealing with the climate risk for a fund like this. So after a few years of having a dialogue with companies and investors, we decided to write down our expectations and spell them out in an expectation document. That's all the way back to 2009. After that, we presented this expectation document as a document to the board to have as a guide for how to look at these issues at the company level. And immediately after that, we started to map the disclosure that firms have had on climate-related issues and all the way back to 2010. We have seen significant improvement in disclosure from these different companies, but it's still a long way to go. It's only around 1 out of 10 companies who directly report simple measures like carbon footprint. But still, we have seen a positive development to the extent that quite a few companies now are reporting at least to CDP and other institutions and databases. Now, we have since then figured out that we actually have to come up with, as investor, more clear numbers on how our portfolio is exposed, what kind of carbon footprint we have in the portfolio in total. And this is a work that has entailed us to collect more and more data and try to improve the quality of the data that we get from different sources. So in our annual report, we have reported the combined carbon footprint from the portfolio since 2014. And we have calculated our current carbon footprint at around 100 million tons a year. So for all the companies that we find on the major exchanges, the combined carbon footprint is probably around 13 billion tons a year. And we own roughly a percent of this, and slightly less, since we have a different composition of the portfolio. One of the later initiatives we had, and one of the things we have been moving forward on now, is also to start to have a dialogue with the banks and take a look at how their lending portfolios have developed. And we have in 2017, for the first time, then gone into a discussion with 55 of the major banks in the world about how their lending book actually looks like. And this was a consequence from our reporting on how our carbon footprint from our bond portfolio looked like. So what we've seen over time is that, and what we really have learned, is that if you should get anywhere here, we have to move from words to numbers. Words is, of course, important to encourage activities. But from our point of view, to go from words to action, you have to have the middle step of getting the numbers in place. So our key message here today is a very simple one. We will encourage companies, but also investors, to focus on getting good numbers and in more detail that we can report on and then start to manage, because what gets measured will get managed, and eventually that will have consequences from the actions both for the companies and for the investors. Thank you.
Great, thank you very much. I think you can begin to see there's both some common themes beginning to emerge here, but also some really interesting variation between the funds as to how they're tackling climate change issues. Mr. Sabia, can I turn to you now? Your fund also recently announced a comprehensive climate investment strategy. Could you tell us a little bit about what you've committed to and perhaps why?
Sure, thank you. You know, it's a paradox of life. In Canada, when the media writes articles about us, they always choose to start it with the giant CDPQ. Today I have a trillion and a trillion on both sides of me, and I can assure you I feel a good deal more like a hobbit than I do a giant. In any event, let me talk a little bit about our work on climate change and the plan that we've embarked on. Our thinking on this is basically rooted in two fundamental convictions, which I don't think is going to surprise anyone in this room. First, and very importantly, that in our minds, climate change and the actions required to address it have now become an issue it has become a consumer and a citizen issue. It is no longer only a government issue. It's a government continue to play an important role, but this is now rooted in consumer preferences. Second conviction, that the speed of technology in addressing this issue is accelerating, and it's important not to underestimate how fast we think those technologies will continue to develop and to improve. Now, if you put those two things together in our minds, climate change becomes, or the issue of addressing climate change becomes one of the transformative trends that is changing the world that we invest in today, and that is very much going to change the world of tomorrow. Therefore, in our minds, climate change and addressing it raises two sets of issues. Yes, a set of risks and constraints, but very importantly, a set of opportunities from an investment point of view. And that therefore an adequate policy to address it has to capture both the risks and the opportunities. So where does that leave us in terms of the elements of the plan that we've embarked on? So it's basically four pillars to this plan. First, that climate and climate change has to be an everyday component of how we work. It has to enter into every investment decision that we make across the breadth of asset classes that we manage, and we manage across the full breadth of asset classes. To do that, in other words, while investors like us every day manage risk and return, in the future what we're saying to our investment teams is, well, now you have to triangulate return, risk, and climate impact. And it's those three things that have to be brought together to make every investment decision that we're going to be making going forward. To do that, we've developed something that we call carbon budgets, where every asset class and every investment team has a carbon budget, and they have to live within that in the same way that they have to live within a risk budget. So that's pillar number one. Pillar number two, to keep an eye on this issue about the opportunities and making sure that we're well positioned for the future. We've committed to increasing by 50% by 2020 our investments in low-carbon assets. Today, we invest about $17 to $18 billion in renewables, highly energy-efficient businesses, transportation systems, and our commitment is 50% increase in that by 2020. Second pillar. The third pillar is to lower our carbon intensity, the carbon intensity of our portfolio by 25% by 2025. And we'll use those carbon budgets that I mentioned a minute ago to do that as we bring those down step by step to achieve that target of a 25% reduction in our carbon intensity. And then finally, that's the third pillar. And the fourth pillar, like a number of my colleagues have talked about earlier, and that's engagement. That's working with portfolio companies, particularly those companies where we have large stakes, and in North America and in Europe we have substantial stakes in a number of companies, to do what my colleagues have already referred to: improve disclosure, share best practices, encourage a reduction in emissions, all aimed at changing corporate behavior, as corporate behavior has to change as we step up to this enormous challenge. And then finally, obviously, we will report on all of that on an annual basis, because we think it's important that this plan be not just achievable and measurable. We think that plan, we have to be transparent. It has to be reportable so that we're held to account. So those are the elements of our plan.
Great, thank you. Thank you very much. Some really interesting insights, I think, emerging from the discussion so far. Mizuno-san, can I turn to you in terms of the commitments the GPIF have recently made around committing a substantial portion of your equities portfolio to ESG indices, but also some of the observations that you've made yourself in speaking eloquently on the need for long-term investors to be taking into account these issues. I wonder if you could provide some comments on the approach that GPIF has taken and your perspective as an asset owner.
Thanks, Emma. And GPIF is probably less known to the audience here compared to my peer panelists. So just to give you a brief description of who we are, GPIF manages 1.5 trillion Japanese public pension reserve fund, and our portfolio is very well globally diversified. And GPIF is actually the universal owner by textbook definition, owning the more than 66,000 global listed company and all the government bonds across the capital markets. And we are super long-term investor, as we are designed as a part of a 100-year sustainable public pension fund scheme of Japanese government. So we really have to pay attention to the sustainability of our portfolio. And when we looked at our portfolio, and which is very well diversified from that perspective, we came to realize the one inconvenient truth of the global diversification, because the conventional diversification of the portfolio reduces our exposure to short-term volatility, but actually increase exposure to long-term sustainability of the portfolio. So we are now taking very, very holistic and honest view of the portfolio management, and we are trying to make a systematic approach across asset classes. So now we, apply the ESG. We don't really, pinpoint or deal with the climate risk as a standalone risk factors, but we just trying to integrate ESG into our portfolio management across all the asset classes and also globally. And the other interesting perspective, or GPIF has, is given our regulatory restriction not to directly invest into the companies, we outsource 100% of our equity portfolio to the external money managers. So everything we do to increase our portfolio sustainability, we need to do it through our external money managers. So how to use external managers to make our portfolio more sustainable? We concluded the two key factors we need to work on. One is the how to use index, because not only a passive manager, but active manager's performance is evaluated relative to benchmark. So the benchmark is so critical for our portfolio. So last year, we selected 3 ESG indices for Japanese equities, and we put about $10 billion behind those 3 indices. And now in the middle of the RFP, requesting for the proposal from the index vendors to create a new global environmental index. And we are planning to put a significant amount of money behind it to make the benchmark more sustainable. And the other thing is we are urging our asset managers to integrate ESG factors into their investment analysis, and also we urge them to engage directly with the company on the significant ESG issues. And when other people talk about engagement, it's an engagement with the company, but for us, it's an engagement with asset managers and the benchmark provider to make it more sustainable. So we are aiming to increase our, the sustainability of our portfolio, and in other words, trying to reduce our exposure to the climate risk. And that's the approach which makes GPIF a bit more different from other, the peer sizable asset owners. But I believe that in terms of numbers, majority of asset owners has the same restriction, probably not by regulation, but they don't have a resource to directly manage their portfolio. So we are trying to set a sort of role model how to use or work with the asset manager to make the investment chain more sustainable. Thank you.
Thank you. Thanks very much. I think some really interesting thoughts for the panel to follow as well in terms of how asset managers are also responding to these challenges in terms of their relationship with asset owners. So, Peter, coming to you, both in terms of your role as CEO of PKA, but also in terms of being chair of the Institutional Investors Group on Climate Change, our European investor organisation who we work very closely with Ceres, as well as the Asia Group as well. Can I ask you just to provide some comments in terms of how some of the actions that PKA and IIGCC are also taking in dealing with climate change?
Yes, thank you, and first of all, thank you to Ceres for inviting their European cousins. I'll start with PKA and say that what we do in the climate area is actually based on 2 things. Firstly, our members, and we run 4 member-owned pension funds, they actually want us to do a difference. And the second one is that we think there are some risks out there and some opportunities out there that we have to handle. We look at the area, we look at climate investing in 4 areas. We do engagement together with colleagues both in Europe and also here in US. We also do divestment in some cases where we find it necessarily. We look for the opportunities, and then we do some policy work together with the other organizations here on the world scale, but also more specifically in Europe towards the European Commission and with different member states. If I look at the opportunity side, we decided 6 to 7 years ago to build up what we have called a green portfolio at PKA. And today we have 3 billion in green investments, and that's compared to that PKA have 40 billion of assets under management. So we actually have 6 to 7% of our portfolio in that area. And what we defined as green investment is the biggest part of it is offshore wind parks, and that they're quite big in Northern Europe. And it's sustainable forestry, and it's green bonds. And we have set up a special team to do some of these investments, especially the offshore wind investments, because it's complicated, both seen from a financial point of view, but also technically. We want to build that up so we have 10% of our investments in the green area by 2020. And we hope that most of this will be in these offshore wind parks, because this is really an area where you can be as a long-term investor. If I then turn to the risk side, we have for many years been a dialogue with different companies, but we decided 3 to 4 years ago that we would especially look at the coal sector, and we divested some of the 100% coal-based companies, and also have divested some of the coal companies that didn't really have a strategy on moving forward. And we are going to start the same dialogue with the oil and gas companies. And I think if they are not going to have any kind of strategy for a 2-degree future, we might also end up divesting some of these companies. When I turn to IRGCC, I can say for PKA, it's extremely important to be a member of an organization like that. In a Danish context, we think we are a large investor. In a world context, and you can see the other ones here, we are a small one. But working together, for instance, in the Climate 100 and in other areas, we really can get the investor voice heard. We also do policy engagement, and we also at IRGCC is facilitating for our members how you can make different solutions. We have seen a growing interest since Paris. I think we had 80 members if we look back 4 years. Now we have passed 150, and we are representing 23 trillion. I don't think it's the members that count, but when we come to the EU Commission, I can see that 23 trillion counts.
Thank you. Thank you very much. I think some really interesting views. I'm going to run back down to the other end of the table, and I think that's a really good segue back to Controller Yi in terms of the comments that you made around the Climate Action 100 initiative. I guess what I want to ask you in terms of looking at the broader institutional implications of these sorts of activities, what do you think it will take for an initiative like that to be successful, and what kind of impact do you think it has the potential to have as a whole?
Sure. Whether it's the engagement of my colleagues here up on the dais, whether it's with asset managers or whether it's really helping companies with respect to doing its own carbon footprinting, the fact of the matter is that in order to deliver on the Paris Agreement, we're talking about cuts that are going to be required of around 80% in global greenhouse gas emissions by the year 2050. And while we're focused on that, also being able to pursue a just transition for people who are employed in these affected sectors. And so, I look at Climate Action 100 as really being all-encompassing of these points of focus. Success on this front means really having to compel some of the world's largest carbon emitters to make changes in their business strategy, to really understand the degree of their own emissions, and also examine their governance, and obviously disclosure is a big piece of this. And so investors will need to conduct thorough research and be persistent in terms of obtaining this information, offering companies a viable and hopefully sustainable path towards a low carbon economy. And so I think the success really is about being collaborative, being strategic, being specific about the disclosure that we are asking of companies. And the initiative is named Climate Action 100+ because investors initially are focusing on engaging with the 100 of the world's largest corporate greenhouse gas emitters. And I just want to say this because I've been hearing over the last couple of days about the 100 companies that have been identified by the steering committee. And this is not to shame anyone. This is really a reflection of our current economy and the state of our the sectors of our economy that really are working against the goal of the Paris Agreement. And I do think this collaborative global engagement strategy is really to kind of keep along a common goal of how we're going to have these 100 emitters establish low carbon transition strategies. Really, there's no choice. And we need to do this with a sense of urgency. We need to do it collaboratively. We need to do it globally. Other companies that investors also consider to be potentially exposed to climate-related financial risks will be added to the focus list this year. And so the goal of this is to engage with companies, to say to companies, we want to help you get off the list, but we need to understand what your risks are, and to also understand how you plan to address them. And so through engaging the focus list of firms together, investors participating in Climate Action 100+, will be requesting that companies take action to reduce greenhouse gas emissions across their value chain, consistent with the Paris Agreement's goal of limiting global average temperature increase to 2 degrees Celsius, provide enhanced corporate disclosure in line with the final recommendations of the TCFD, and also then implement a strong governance framework that clearly articulates the board's accountability and oversight of climate change risk and opportunity. So this has never been done before. We realize it's ambitious, but I think the numbers are beginning to speak for themselves, and I know numbers are important here, but the level of interest thus far with just wanting to engage in this collaborative manner with partners across the globe is really the goal of this, and we believe that we can see successful outcomes with this in terms of a low-carbon future.
Great, thank you. I want to pick up on that theme of governance in turning to you, Comptroller Stringer. And you mentioned some of the success that you've had so far through the Boardroom Accountability Project in getting climate change issues into the boardrooms of US companies. But you're also now beginning to increasingly focus on divestment. Can I just ask you to elaborate a little bit more on that in terms of whether this signals a shift in your approach or whether it's building on previous actions as well?
Adding to our approach. I am very committed to engagement. It's what we do around the world with our companies. We're going to continue to engage with steel makers and automakers to demand that they cut the demand for oil and energy. We're going to continue to be with Ceres on so many of these important engagement issues. But what I worry about is that we may not be moving fast enough if we don't add some more tools to our strategic plan. You know, we don't inherit the earth from our ancestors, we borrow it from our children. And I think there's a lot of parents out there who wonder whether we will be in a position unless we take more drastic action. I do believe that the divestment movement, the genie is out of the bottle. And I think it can be a positive provided that we act with the highest fiduciary standard, provided that we do the examination of our portfolio and what we can and cannot do. It is an extraordinary opportunity to send a clear message that we are very much committed to both engagement and a divestment strategy. And while I can't say today we have all the answers, I'm not sure, especially in the United States, given who our president is, that we have any answers coming out of our government. But given the Paris Accord, we have to do better, and I think that's putting all the tools on the table. And I hope we can all have that discussion, no matter where people's different mindsets are.
Great, thank you. Continuing with that theme, Yngve, I know that Norges has already divested from more than 50 carbon-intensive companies from your portfolio. Why do you, in terms of your own financial approach to financial risk management, but why do you think that it's important for the global institutional investor community to be acting on climate change issues in this way?
As Scott and the other people on the panel has mentioned, I think it's quite useful to distinguish between the ownership activities. If you find yourself as an owner with rights and obligation, how do you exercise your ownership? And the second question, and quite often a different question, is what do you really want to own? For the first question, as I said, we're mainly concerned about getting a dialogue with the companies where we spell out our expectation with regards to investment plans, risk management, and disclosure. With regards to what we're owning, we're seeing that the different institutional investors are taking quite different approaches. Our approach has been to think about this way of investing as identifying the areas where the market doesn't work, where the market hasn't priced in externalities. And that really entails two things. First, with regards to the divestments you talked about, there are clearly some companies which have business activities that impose a cost on society that is not priced. We started divesting first from the palm oil industry, who had a considerable activity in Malaysia and Indonesia by cutting down the rainforest. We extended that later to coal miners, and again we went further and sort of said, well, we're looking at also at electricity producers, and we have divested from all electricity producers that have more than 30% of their energy mix from coal. We also looked at sectors like cement and a few others. So the common thread here is that those companies that do have a large carbon imprint, we will actually just divest from. But that is kind of the tail end. But it's more than 200 companies that we have taken out of the portfolio in total. But we're also looking at the positive end of the spectrum. There are companies who actually then give positive externalities to the society at large. And this will typically be areas like environmental technologies. It could be anything from water treatment facilities or new technologies. In that area, we really have distinguished, and we have 3 programs going for our investments. The first is low emission and alternative fuels, which I think is most people in this seminar will be thinking about. But we are also investing quite a bit, and nearly as much in the energy efficiency and, area. And the third area, which for us has become increasingly important, is natural resource management. So we're trying to put up a wide program where we're investing in companies who actually, in addition to the revenue they get, do have positive externalities for society as a whole. And I think this combination of investing less in those with negative externalities and more of those with positive externalities is the way that we have found an adequate approach from our point of view.
Great, thank you. And I think that's a very nice point to pivot the conversation in terms of moving from understanding climate risk to also pursuing climate opportunity in terms of some of those new emerging low carbon investment opportunities. And Mr. Sabia, if I could turn to you in terms of CDPQ's commitments around increasing investment into renewables, both in terms of your own portfolio, but also what you're seeing across the industry. And we've also heard quite a lot this morning from some of the other presentations around projected growth in low carbon opportunities as well. I wonder if you could talk a little bit about whether or not you see enough projects coming to market to support what we see as increasing investor demand for low carbon opportunities.
Sure. Well, look, to state the obvious, the world's facing and is in the midst of a massive transition to a lower carbon economy, and that's something that's going to take a number of years. But we're a very long-term focused investor. So when we think about this, in fact, what we see is the emergence of whole new categories of opportunities for investment. So shortage is not the way we worry about this. We think that there'll be more than enough. In fact, I think the challenge perhaps lies a bit elsewhere, but very, very large opportunities here. Let's just quickly, go through some of the categories here, and I think you'll get a sense of how big, or at least how big we think this is. I mean, renewables. And I should say, when I go through this list, we're not doing this out of a sense of altruism. Yes, we have a sense of social responsibility about it, but these are profitable investments. I mean, we're a fiduciary, and as a fiduciary, we can't make investments that aren't in the interests of the people whose assets we manage, the pensions that we manage. So, consistent with that framework of profitable, I mean, renewables. We have today about order of magnitude about $10 billion invested in renewables around the world, and we're substantially increasing that. Those are solid, profitable investments. But from a more global point of view, to some things I've read that to achieve Paris, for instance, the Paris goals, the world's reliance on renewables is going as a source, as a percentage of the source of energy is going to have to go somewhere in the order of 50 to 55% of total energy supply. That's 2 to 3 times where we are today. That opens up an immense opportunity for investors like us. Think about cities. I mean, one of the great underlying trends in the world today is urbanization, whether it's in emerging markets, well, particularly in emerging markets. Those cities are going to throw up significant investment opportunities for people like us in at least 2 or 3 areas. First, in the rebuilding of buildings, the construction of new buildings that are much more highly energy efficient, where again, we have presence and we've done a lot of that, but we're going to be doing a lot more of that in the future. That will be, for those of us who invest in real estate and invest directly in real estate, that will be a huge opportunity. Think about transit systems. An enormous opportunity there, given, yes, the enormous importance of building transit systems in emerging markets, but equally well of rebuilding and refitting transit systems in developed economies. As one example, we are just a couple of months away from launching the building of what will be the world's third largest electrified urban transit system ourselves, that we will be building this ourselves. That, from beginning to end, will be a carbon neutral project. We want to take that idea and export it into the U.S. cities, where a pension fund will go into a U.S. city and build a transit system, build, own, and operate a transit system. That's something that is highly profitable for us because of the stability of the returns. It's also a good thing to do because those cities require that. Think about water systems. Think about water treatment systems, never mind utilities. Whole new generations of opportunity there related to technological change. Think about the emergence of smart grids, and we're just at the beginning of that technology. But that technology is going to have to replace trillions of dollars worth of existing electric transmission systems around the world. All this to say that in our minds, this is filled with opportunity for investors like us. The challenge is this. It's not that there's a shortage. The challenge for an investor like us is going to be building the capabilities, the competency, finding the people, the engineering skills, the technological skills to be able to invest as a prudent, wise investor. It's acquiring capability. That's the challenge for an investor like us.
Great. Mizuno-san, you talked before about some of the ESG indices that GPIF have supported, and then also new environmental indices being built. As we see the growth of passive investing globally, do you see the emergence and the development and the increased capital going into more and more of these ESG and low carbon indices as well?
Well, in recent media interview, I made a quite bold prediction that the AI will take over all the short-term profit-making trading. And if the human want to survive in this industry, they have to pay attention to either more long-term value or more holistic approach to the system. Because, you know, we have been seeing a lot of situations that well, let's take Tesla as a good example. When we make a lot of return from Tesla, we lost more on the GM and the Ford at the same time. So we need to make the system more sustainable. We have to make the system more win-win rather than the winner-take-all situation. So the reason we have been focusing on the benchmark is that the benchmark is probably the most convenient tool for us to approach the system rather than trying to beat the market or beat the competitors. So the one thing we are trying in Japan, as we own the 10% of Japanese listed equity, is that trying to increase the efficiency of the communication between the company and the investors. So for our ESG indices, we demanded the index vendor to disclose their scoring methodology, so all the company knows how to improve their ESG, including the climate risk or like a carbon footprint, the efficiency. And we are hoping the other, the investor can use it to create the investment opportunity in those indices. And we see the macro trend of the millennial generation want to invest into those sustainability more than our generation. And then more than like $3 trillion will be passed on to that generation from baby boomer for the next decade. So we need to pay attention to the macro shift of the capital, and which we should just, the price into. And the other thing we have been focusing on, as you mentioned about, is the passive manager. And when we started demanding our passive manager to engage with the company on those climate risk issues, the industry responded quite negatively or defensively, saying like we are not paid enough to do that. But we are urging them to change their business model so that they can be active owner or active fiduciary ourselves. And as I keep repeating, unless the big peer managers or investor on the panel, majority of the insurance investors as well as retail investor, they have to depend upon the passive management. And the passive manager has no choice but to step up as an active owner if they wanted to continue to receive their business from us.
That's a fairly direct challenge there, I would say. Peter, let me turn to you in terms of some of the steps that your fund and also a number of other Danish and Northern European funds have taken in terms of focusing on investing in clean energy, and particularly in emerging markets. And just to pick up on that theme as well, we tend to focus a lot on developed markets, but where do you see the opportunities in emerging markets as well?
I see the opportunities in really, if you look at the Paris Agreement, and if you look where a lot of the changes are going to be, in the developing markets or the emerging markets. Clearly there are problems if you're going to invest in that area, and some of the problems are that you might not know the local political situation, you might not know the market. So on beforehand you would think, and I think it's correct, that it's more riskier than investing in the developed market. But if we really have to do something about the climate issue, we have to have more investments in the developing markets. And therefore we started a dialogue with the Danish government 5 to 6 years ago on how we could do it, and we agreed to send up a common fund between some of the institutional investors and the Danish government. We bring 2/3 of the money and the government comes with 1/3 of the money. And when you also had an agreement that they should take part of the downside risk, so that these investments that we actually thought would be more risky than the more normal investments we had, when this was done, they actually look like the more normal investments. And we have invested nearly all the money in that fund. That was $200 billion. It's still early days, but we can see that this is going to give a positive return. We don't know yet how big it's going to be, but there are possibilities out there and they're growing. So therefore we have set up a new fund with the government, and this time it's twice the size. And we hope in this way to get private money to work in this area where it's very difficult. We invest together with development banks and other institutions that normally work in that areas, but we see also more and more private investors coming into that area. And therefore we have, together with one of the big Danish company, started a 100% commercial fund, you could say, and the target is $100 billion, and it's for infrastructure in Africa, and most of that infrastructure actually will be renewables in different areas. So I think the opportunities is out there. It's not easy, and you have to work with local people to find the opportunities. But again, if you look 20 to 30 years ahead, a lot of the development, a lot of the growth in the world are going to be in those markets.
Great, thank you. And because everyone's done such a great job in terms of sticking very tightly to time, that gives me leeway to ask one final question without notice to the panel. And this is a lightning round, so I'm really looking for a 60-second response. If you think of the theme of the panel as a whole, in terms of the action that asset owners are taking on climate change, what would be the one message that you would want this room to walk out of here and remember in terms of what you consider to be one of the most significant changes in the way that asset owners are dealing with climate change that you're really seeing going into the next 2 years in particular? So forward-looking, 60 seconds, key message, the role of asset owners on climate change. Betty, I'll start with you down the end again.
Actually, I will say that it is essential that we really work in partnership. When we talk about the urgency of this, the breadth of work that needs to be done as investors, the amount of information that will be shared in terms of the engagement work that we do, I don't see how we can really make a lot of headway without really engaging our partners globally. And this does have to be done in partnership. And I just want to thank Ceres for recognizing that. And really, this is the impetus behind the Climate Action 100+ initiative.
So partnership, Scott?
Yeah, I have to tell you, every time I have a conversation like this through Ceres and every time I get to have a conversation like this through Ceres and really bring some of the great leaders in finance to the table on this, you really do see that this is becoming now a topic and an issue that is on everyone's mind, both in terms of the future of the earth, but also the future of our companies, the future of finance, and I think that is very hopeful. And I do agree with Betty that the more we dialogue, the more we're willing to have open minds, the more we're willing to implement strategies, even if these are strategies that still have to be developed. These conversations must happen, and so I'm just very glad to have been part of it.
Great. Yngve.
Yeah, I think for us, first of all, there's been a considerable change in the attitude, both from investors and particularly also companies for the last 2 years, I would say. And I think the important thing for us is that we start to get the numbers in place on these metrics, not only with regards to how much companies have as a combined carbon footprint, but the business segments, country segments, standardization of data, and more detail, because it's only then that is actually managed, and before it's managed, it's probably not going to make a lot of difference. So for us, again, it's going from words to more standardized and detailed numbers that we can work on in our risk management and our investment.
Great. Michael.
Well, I think I'd say that at the end of the day, for an asset owner like us, this is fundamentally an issue of culture change. And when I use the word culture, I don't mean sitting around a campfire singing Kumbaya. Culture is about how work gets done. And this is fundamentally integrating this very important issue into the day-to-day decision-making of an institution like ours or others, so that it becomes a modus operandi of how you go about making investment decisions with this equal balance on managing the risks and seizing the opportunities.
Hiro.
Yes, when we asked the CEO, CIO of the asset manager, what do they think as the significant ESG factors? Everybody says climate risk, but we recently ran the survey among fund managers and among our active managers. Very few active managers, fund managers responded climate risk to significant ESG factors. So we need to make sure not being confused by their marketing pitch, but we need to directly discuss with them who manage your money to integrate ESG issues in their daily decision making, particularly climate risk. That's, I think, the asset owners should pay attention to.
Thank you. Peter.
I think I'll point to something about the fiduciary duty. I think it was very interesting, and the fiduciary duty we all have. There was a poll made in Denmark by the whole population, and they asked how strongly you should work as an investor in the climate area. And the younger the people they asked, the more they said, working with climate is extremely powerful, is what we want actually to do. So the question about this is something for the coming generation, and the fiduciary duty for that generation is to make a difference.
Great, thank you. Well, if I was to do my own 60-second summary, I would say that we heard the importance of partnership, the clear evidence of momentum and progress, the ongoing importance of greater granularity and information on numbers and data, the importance of culture and embedding it into mainstream investment decision making, the fact that there's still a lot more work to do and a lot more conversations to be had in terms of making this, getting this beyond marketing pitch and into everyday practice, and then to bring it back very firmly to the number one priority, which is fiduciary duty, but not just for today, but also into the future. And I hope you would agree with me in saying that I think we've had a really fantastic panel discussion today from a great selection of speakers and perspectives. And please join me in thanking the panel. Thanks very much.